So welcome good people. We want to look at this is a very short question. It's question 5, December 2021 paper. It's a theoretical question, so we'll take just less time to look at it. These are questions that we're supposed to save on time and spend most of the time on the calculation questions. So describe 4 purposes of financial accounting. 4 purposes of financial accounting. There are so many reasons why financial accounting is important. And the first purpose of financial accounting is that it aids in decision making. And when we talk about decision making, we are talking about, there are so many things like in a business organization, like make or buy decisions. Do we make ours or do we buy? Do we outsource? Do we possibly invest in a certain business or not? All this will come from financial accounting information. They're able to tell us our financial standing, which will help direct us in terms of making decisions, especially on our financial stability standing, so that we can make decisions that are informed, that will not affect the organization, either in the short term or in the long run. So yes, financial accounting are used for decision making. They guide the managers, especially decision making. They also guide the ownership of the business, whether to put in more money into the business or not. They guide the potential investors. They guide the financial institutions on whether to lend money to the business. So generally, financial accounting is used to guide, especially in decision making. They help people make informed decisions. The other thing about the importance of financial accounting or purpose of financial accounting is that the information is used for planning purposes, especially when you talk about the predictive nature of when you are trying to predict the future, predicting the future. The best way to predict the future is to use the historical information, historical and present information. So we use the historical information to help us predict with some level of certainty and accuracy on the future. And the best place where we can get this historical information is the financial books, which basically keep the financial accounting information. So once we have the historical information, we can predict with some level of certainty on the future, based on the figures, based on our past, what we had managed to achieve in the past. So yes, it's used for planning. And when we talk about planning, we're talking about things like budgets, very critical in any organization. So you can't just come with figures from nowhere. These figures at least need to have a bearing, and the best bearing any business can have is the previous records, which will be gotten from the financial accounting information. Then we also talk of just knowing the performance of the business, how the business is performing. And here we are talking about things like, the reports. We normally have the periodic reports on like the outstanding debts, the outstanding bills. We have profitability. We have the balance sheet, which shows the position of the business as at any given point in time. All these are financial accounting information, and so they help us to gauge the performance. If the business is doing well, if the business is not doing well. No, those questions are best answered by accounting or financial information. We have all these reports that can be pulled if we maintain the financial books of accounts. Then, of course, after pulling these financial books of accounts and you find out that maybe things are not working the way they are supposed to be working, then you need to take the corrective measures. So it is this accounting information that will also open our eyes and direct us, especially when we are performing the control function of management, on what to do to correct the variances or the deviations that have been noted. So normally deviations, variances are supposed to be corrected well in advance. But how will we know that we have variances and deviations? It is through the accounting records, that this is what we had anticipated and this is what we have achieved after implementation. Then we have the variances. Whether we have performed well or we have not performed well, all of them need corrections. It depends with the side you are in. If you have performed well, then we need to up our game. If you have not performed well, then we need to check on what possibly could be the problem. And so what this means is that accounting information basically helps us to play that control function of management and come up with corrective measures well in advance. It's also used for, the other purpose is that it fulfills the requirements of the government. Basically, it puts us in good books with all the stakeholders, because financial accounting information is a requirement. It is a requirement. Since it's a requirement, it basically puts us in a better place to do business, because our compliance level to what is expected of us will be achieved. If we don't keep the financial books of accounts, then we will not be compliant, and that means that we are putting our whole business at risk. So one of the purposes of financial accounting information is to keep us in good books with all our stakeholders. Without it, we may not be able to do the business. So it's a very essential document, and it helps us be compliant, hence continue with the business. And of course, it's also used for referral purposes to know our past, and this past can be used by different stakeholders, including ourselves. The past information is very important. We can always refer there. We can always go there for help, so that we don't do the same mistakes that we did in the past, or we basically use our strengths in the past to continue making the most out of the business. So it's very important to refer where we've come from and learn from the mistakes we did. This can be one of the key reasons for maintaining the financial book, so that we know we did this and we got this. At the end of the day, we will not repeat the same mistakes that we did some time back. And of course, this information, financial accounting information, is also, we talked over things like credit worthiness, financial position of the business. All of them will be used in decision making. So I think we can work with this, and any 4 points that we will pick up from this will simply work. And there are so many, we may not even exhaust. Even communication. Financial accounting information is the best tool actually for communication. We talk figures, that is the language that businesses understand best. So you can very well express what is happening in the business using financial information, and that means that it is a tool that aids in communication with all the stakeholders and makes communication very, very, very simple and convenient. So all this, just pick any 2 points from this, and you will have your 8 marks, of course, after explaining. Pick 4 points from this and explain them very well. Each point should give you 2 marks. Then explain the following accounting concepts. Going concern. Now, what is going concern? Going concern is simply an accounting concept that means that we do not foresee a future that will possibly what do we say? Our expectation is that the business will be in operations for the next so many years in operation. That the business will be in a position that it cannot meet its current and mature obligations when they fall due. So we are looking at a situation where the business doesn't have a threat of liquidation. This is a going concern. Simply means that the business doesn't face the threat of liquidation in the near foreseeable future. So that means that the business is quite stable to withstand all these other threats that might come its way. The business, we are sure that the business will be in operation for the next future period of time. It's financially stable to meet its current and maturing obligation for a considerably longer period of time. We say that that business is a going concern. So going concern means that at least we are sure the business is there to stay for a considerably longer period of time, and that the business is not faced with the threat of liquidation. Liquidation is where the business basically comes to its wound up because of one or two reasons. It's not able to meet its current maturing obligations as and when they arise. So if that is the situation, then you say the business is a going concern. It will be there in the next foreseeable, in the next future period of time, and we don't foresee a situation that will possibly lead to its coming down or being wound up. Then we have these are the term that is accrual. The accrual concept is also a very important accounting concept, accrual concept. And what this means is that simply the revenues and costs or expenses are recorded as incurred and not as paid or received. So we can just add something here. The revenues and costs or expenses are recorded as earned or incurred and not as paid or received. So we record when we actually earn the payment, the time that we did the period in which we did the job. That is the period that we're going to record that income. Or the period that we actually incurred the cost, and not when we are going to be paid. So we can do the job in 2018 and get paid in 2019. We do the job in 2018, we get paid in 2019. In such like cases, the income will be recorded in 2018 because the job was done in 2018, money was earned in 2018. It was only received in 2019. So it will be recorded in the 2018 books. So the accrual concept simply says that we record expenses and incomes as incurred or as earned, and not as paid or as received. You can receive it in any period of time, but let's record it as that time when it was actually earned. And this is in line with the matching concept where revenues and costs are supposed to be put in the same accounting period. They are almost related. There is a very good relationship between accrual concept and matching concept. So, revenues and costs, expenses are recorded as earned, revenues as earned, costs as incurred, and not as paid or received. Thank you. So, the next one is consistency. The consistency. This is also one of the key accounting terms. And consistency simply means that whoever the accountant is, or they should follow the same accounting, principles, adhere to the same accounting principles, methods, procedures, and practices over time. We should not be talking about this year we are doing this, next year we are doing different things, the other year we are doing a total different thing, the other year no. That will be inconsistency. Consistency demands that the way we handle a certain transaction this year should probably be the same way we are going to handle it the following years, which should also be the same way we are going to handle it the other year. Unless there's a very good reason to deviate from that reasoning, then we should continue doing the same things that we were doing before. For example, if depreciation is a policy that we have, as a company that will be providing depreciation at the rate of 10%, then let it be 10% and let it be applied consistently. Not this year 10%, the following year 20%, the other year 15%. That will be an avenue for fraud and confusion. So consistency simply means that we do whatever practices that we adopt, whatever principles, whatever methods, let's follow them for a considerably lengthy period of time, and it should basically flow from one accounting period to the next accounting period. Then explain 3 advantages of maintaining petty cash book on interest basis to an enterprise. 3 advantages of maintaining petty cash book on interest basis to an enterprise. Now, advantages of petty cash book. Advantages of petty cash book. Now, petty cash book, you have the ordinary way and you have the interest way. And this question is very keen on the interest way. The ordinary way is where the chief cashier gives some money to the petty cashier. Then the petty cashier is supposed to, of course, meet these small expenditures that come, suppress these small expenditures that just will erupt from nowhere because of doing business. Those small expenditures that just surface. So such like expenditures are supposed to be met by the petty cashier. So the ordinary petty cash book, the ordinary petty, the ordinary way of maintaining petty cash book is where the chief cashier gives the money to the petty cashier. The petty cashier utilizes that money until it gets finished. Once all the amount has been used up, it goes back to the petty cashier with all the vouchers and requests for more money. And then, of course, the chief cashier will go through all the vouchers. If he's satisfied, he gives him the next batch of money, which again, that cycle repeats. That is the petty cash book maintained the ordinary way. Then you have the petty cash book that is maintained the interest way. The interest way, you are given a certain sum of money for a certain period of time. And when that period comes to an end, you are supposed to submit all the vouchers, and the amount of money that will have been used will be reimbursed. So we really don't have to wait for the money to be there to be completely used up before it can be replenished. At the end of a certain period, you simply show all the transactions that have happened. All the vouchers are presented to the chief cashier. He adds all of them up, and then he reimburses you the monies that will have been used by that period of time. So what that means is that at any given point of time, you will have, the petty cashier will have money with him, and that enables continuity of operations without any hitches. Continuity of operation without any hitches. So that one comes in as one of the key advantages of maintaining petty cash book the interest way, that there will be continuity of operation without any hitches, because money is always there. We reimburse money, and we don't, in most cases, allow money to get below a certain level. So it can either be periodic, or you can just put a figure that if this money gets to this level, the minimum level, then bring the vouchers for replenishment of the cash. So at any given point in time, we'll have money in the business that will be used to meet all those petty expenses that arise. So there is continuity of operations without any hitches, and of course this one comes in with convenience because of availability of money every time. But then, of course, the other advantage that is very obvious is audit. They will talk of audit internal checks and controls which have been enhanced. Audits, that is internal checks and controls, which are enhanced. We don't have to wait for this person to complete what he has before we can. Instead, we are keen, and anytime he can present whatever vouchers he has already utilized, and the chief cashier will go through them and reimburse him the money. So the internal checks, internal controls are actually, for this one, up to date. And this is also good because the fact that the chief cashier is not doing this job, he has basically delegated to the petty cashier. It's also a plus because it means somebody else is doing this work, and so the chief cashier checks on what the petty cashier is doing. And that blocks the chief cashier from having the autonomy of the job, which is very important. So it enhances internal checks, it enhances internal controls, and that, of course, prevents fraud from occurring in the business. The other thing is that normally it's a simple way of keeping books, simple and accurate, because what happens for interest, petty cash to the interest, we have different vote heads. And they are recorded according to these vote heads, and we have a specific person who is the petty cashier who does the recording, and that, because it's a specific person and that is his job possibly, or part of his job description, we are likely to get accurate results, as opposed to pushing everything to the main cashier, so that the main cashier has a lot of work, and at some point he might not capture some of the transaction and you end up with wrong figures. So this is actually very good in terms of just maintaining simple books that are accurate, and also speed. You talk of speed will be observed here, and efficiency. Speed, efficiency, convenience, all these are things. Convenience we've already written here. And at the end of the day, we are talking about time saving. We are talking about things like, time saving. We are talking about things like the minimal effort, because the person who does that probably should have been trained and will keep on doing that over and over again. So that makes it very easy for him, and less, effort will be spent on doing this job. So these are just advantages, and there are some of them are general advantages that will apply to petty cash book system, and some will apply specifically to the petty cash interest way of maintaining the books. So this will make your points. Just go to pick any 3 points that will help answer that question well. Explain 3 advantages of maintaining petty cash book on interest basis. So you can simply talk of availability of money all the time. Then, of course, that one will bring in convenience and continuity of operation. Then internal checks and accuracy levels, speed and efficiency, all those will apply. So, thank you. Let's just pick any 3 and we'll be done. We meet in the next question.